The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. I'm Hongbin Jeong. Well, the U.S. dollar studied on Thursday after plunging to a 3.5-year low and then rebounding sharply as markets digested the Federal Reserve's guidance on future interest rate cuts. Now, analysts warn that this broader-based dollar boost could put pressure on Asian currencies, with the Japanese yen among the most vulnerable. While short-term gains look likely, some experts caution that the dollar's upside may be limited over the long run. So where's the U.S. dollar headed? Well, to find out more, I'm joined by Sim Moh Siong, currency strategist at the Bank of Singapore. Moh Siong, welcome back to the show.
Thanks, Hongbin. It's good to be back.
Thank you so much for joining us. Well, Moh Siong, it looks like the dollar, steadied after plunging to a 3.5-year low, but it weakened initially against the euro and the yen, but later found some support, reflecting uncertainty about how markets interpret that Fed's path. So how do you interpret the dollar's reaction after the Fed's cut? What's driving this two-way volatility?
So the bigger picture here is that the dollar decline has stalled since the third quarter of this year, since the start of the third quarter, after a sharp depreciation in the first half of this year. And this picture of a stalling dollar decline remained intact even after the Fed resumed easing with a 25 basis point cut last week. And we think that the next phase of the dollar decline could be slower than the first half of this year. And we continue to look for grinding U.S. dollar weakness into year-end.
But why did the U.S. dollar rebound following that Fed decision?
So there are a few reasons for the dollar rebound. First, the Fed chair described the Fed's cut as consistent with risk management. It's more an insurance cut, not necessarily the start of a long easing cycle. So the Fed is projecting 2 additional cuts for the rest of this year, and 1 each in 2026 and 2027. And this is very much in line with what the market is already expecting following the poor jobs data at the start of this month. The second reason is that the vote at the September FOMC meeting only showed one dissent in favor of a 50 basis point rate cut. The rest of the committee voted for a 25 basis point cut. And this shows a surprising degree of consensus and help ease concerns about Fed's independence.
Okay. Well, markets are pricing in more easing from the Fed, but, inflation is still above that target and the labor market is weakening. So how will this impact the U.S. dollar moving forward?
So the conflicting backdrop of rising inflation and slowing economic growth from higher tariffs, that pulls the Fed in opposing directions. And therefore, conducting a monetary policy is not clear-cut in this kind of environment. The Fed has resumed rate cut, but when the economic environment is foggy, you go slowly. So future Fed actions will depend on how the risk between high inflation and cooling job market play out. And we think the U.S. dollar looks set for more consolidation in the near term, but with the Fed likely to cut again 25 basis points each in October and December, we expect the U.S. dollar to eventually grind lower.
Okay. Well, while the short-term outlook for the dollar appears strong, some analysts express long-term pessimism. So what are the key factors that could reverse the dollar's current trajectory in the longer term?
So a few reasons why we are still in the weak dollar camp beyond the near term. First, the concerns over Fed's independence could escalate, therefore hurting the greenback. The influence of the Trump administration over the Fed could increase with the expiry of Powell's term as Fed chair in May 2026. The second reason is that the U.S. economy is no longer as exceptional to the same degree as before, and the U.S. dollar could therefore see more downside as the greenback should not command the same degree of overvaluation. And the third reason is that the weak dollar story is not just about fading U.S. exceptionalism. It's also about improving growth outlook in the rest of the world, especially Europe, as Germany steps up fiscal spending.
Well, analysts suggest that Asian currencies are likely to face downward pressure due to the Fed's decision as well. How have Asian currencies reacted so far?
So the Asian currencies are slightly weaker following the Fed's rate cut. Currencies like the Singapore dollar and the Malaysian ringgit weakened slightly on the back of a firmer US dollar. But it's not just about a firmer US dollar post the FOMC meeting. Some of the pressures that we've seen on some of the Asian currencies, like the Indonesian rupiah, are also a reminder not to overlook the domestic story. But bigger picture, the restart of the Fed easing cycle and our expectations for a stronger Chinese currency should be positive for Asian currencies in the coming months.
Okay, well then which specific Asian currencies do you anticipate will be most affected and why?
So the currencies that stood out after the Fed's rate cut were the Indonesian rupiah and the Indian rupee. They have underperformed relative to its Asian peers over the past week. Much of the underperformance were driven by country-specific story rather than the Fed. And for the Indonesian rupiah, the shift to a greater pro-growth bias that's resulted in a surprise rate cut in Indonesia last week, that has complicated the central bank's currency stability goal, and that in turn has hurt the Indonesian rupiah. For the Indian rupee, the punitive tariffs imposed by the U.S. on India's exports and the U.S. visa-free hike are a headwind for the Indian rupee. There has been some de-escalation between India and U.S. on the trade front, but we have yet to see any resolution.
Well, overall, Moh Siong, how do you view the implications of policy moves between the U.S. and other major economies on global foreign exchange markets?
So the Fed has lagged other major central banks like the European Central Bank in cutting rates, but as the Fed plays catch up with rate cuts, FX hedging costs will decline. And this should spur more FX hedging activity, contributing to further dollar depreciation.
Okay. Well, of course, investors are now wondering how to position their FX exposure when the Fed is cutting, but inflation and global risks remain elevated. So, Moh Siong, what strategies should investors consider as more rate cuts are in store?
Our view is that ultimately for more dollar decline, therefore, the recent dollar strength could provide investors with an opportunity to diversify their portfolios out of excessive U.S. dollar exposure. The Fed rate cut should also be positive for gold. Gold is a non-yielding asset, unlike equities, which pay dividends and bonds, which pays dividends, and bonds which pay interest. Gold prices tend to increase when the Fed eases because the opportunity cost of holding gold falls when U.S. interest rates decline.
And anything else we should look out for as well for in the coming weeks that could affect the U.S. dollar?
So the Fed has made it clear that it will be looking at the data very carefully, especially labor market data. The key U.S. jobs data at the end of next week will therefore be important. And barring a strong payrolls report, we believe the path is set for a further 25 basis point cut by the Fed in October.
Some great insights from you there. Thank you so much, Moh Siong, for joining me today.
Thank you.
Thank you. That was Sim Moh Siong, currency strategist at the Bank of Singapore. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.